So let's move on to the next piece of the podcast then. We're going to be talking about pensions because leading up to the budget, there was talk of changes to the amount of tax-free cash you could take, and people started raiding their pensions. Well, of course, we now know that changes didn't come about. And so, Damien, there's lots of questions that people have with regards to what to do with this tax-free cash that they've drawn out. Can they put it back in their pension, for example? You've got the answers.
Yeah, so this came about because, as you say, Andy, there were a lot of people that started to withdraw their tax-free cash from their pension, fearing there was going to be a cap on the amount of tax-free cash that they could take as a result of that autumn budget. And as you say, there was nothing actually announced. And it means there are some people who have made some significant withdrawals that are wondering, well, what to do with that money and would rather have it back in their pension to grow tax-free. And so I've received correspondence from people, and I know of people who have said that they did this ahead of the budget. Now, this is a very good example of not trying to preempt something that you don't know about. So I think there's a warning to other people to not take action just because of speculation about what could be in a budget. Of course, if things had come out one way where they had reduced the tax-free cash, they would have won. But there are a number of people now that have made changes to their pensions, and it means that they has an impact going forward. So the first thing to say to those people who are saying, well, can I just put it back? Now, the answer is no, not without any kind of impact and possibly taxation. So the first thing to say, if you have taken the tax-free cash from your pension because of the budget, now some providers will have a window in which you can decide to undo a decision, a calling off period. Now, I've looked around and there are some pension providers that have up to 30 days calling off. So that means there could be some people still within that period, given that the budget occurred at the very end of October. So assuming you're no longer in your calling off period, there may be people who sit there and think, well, I only took the tax-free cash, the 25% that I was allowed. So I haven't triggered the money purchase annual allowance, which is the limit that restricts the amount you can put back into pensions if you start to draw benefits in excess of that 25% tax-free cash. But even if you haven't triggered the money purchase annual allowance, you have to be mindful of something called pension recycling. Now, fortunately, Andy, we did a podcast a few weeks ago on pension recycling and explaining the rules. So that podcast episode was 473. So make sure you go back and listen to that for the full rules and explanation. But in simple terms, the pension recycling rules were put in place to stop people taking lump sums from their pensions that would be tax-free and then trying to put them back into pensions to gain tax relief. So that excess tax relief, the HMRC doesn't want that to happen. And so they put in rules that are quite strict and very clear to limit the ability to do that. And if you fall foul of those rules, you could be hit with a tax charge of up to 70%. Now, I'm not going to go through it in details, but this the highlights that if HMRC believes that the pension contributions were part of a pre-planned recycling strategy, you could face those tax charges. Now, when they look at the pension contributions you make, they look at the contributions made in the 2 years before the current tax year when you took the tax-free cash and 2 afterwards. That can be a 5-year window. If you've taken £7,500 or more in tax-free cash in the last 12 months, so that's in total, and your total contributions have increased by 30% or more, and the pension contributions equate to 30% or more of the tax-free cash that was taken, you may trigger the pension recycling rules, and that can ultimately lead to a tax penalty. As I say, that can be as much as 70%. So go and seek advice if you are somebody who has drawn out that tax-free cash or draw money from your pension and you're thinking about wanting to try and put something back in. Do make sure you seek advice because you don't want to fall foul of those rules. Now, having said all of that, what else could you do? Well, of course, you could use the money that you've taken out for other means. You could gift it to people. You could, in fact, invest it yourself. You could put it in things like stocks and shares ISA, so it could grow tax-free. You won't get any tax relief on the way in. Of course, you could contribute to other people's pensions. So you could put money in for your spouse or your children. So even if they don't earn money, you could put up to £2,880 a year into a pension and they will still get that basic tax relief, taking it up to £3,600. So they are all possibilities. And as I mentioned there, gifting for inheritance tax purposes has become a little bit more attractive because pensions are due to be liable to inheritance tax from April 2027. So I think we are going to see more people withdrawing money from their pensions and giving it away if they are particularly worried about inheritance tax. So there you go, Andy, a very quick warning and roundup for those people who took money from their pensions ahead of that budget of what they can and can't do.